There is a 3-digit number that quietly controls almost every financial decision in your life. It decides whether you get approved for an apartment. It decides how much you pay for a car. And it can be the difference between paying $200,000 for a house or paying $310,000 for the exact same house. The number is your credit score. And right now, according to FICO, the average American sits at just 715. That is 100 points away from the score that unlocks the best rates in America. And most of the advice you have heard about how to improve it is either incomplete or flat out wrong. The gap between a 650 and an 800 credit score comes down to 5 specific behaviors. And most people are doing the opposite without knowing it. Step 3 in particular. Step 3 is a mistake that feels completely logical. It makes total sense on the surface, but it is silently destroying credit scores across the country. We are going to get there. But first, let me show you how this system actually works. Whether your score is 500, 600, or already above 700, by the end of this video, you will have a clear step-by-step system for pushing your score toward 800. Not theory, not generic tips. The exact behaviors that move the needle. Backed by FICO data and Federal Reserve research. Let us start with a story. In 2023, a woman named Sarah in Dallas, Texas, decided to buy a home with her husband. Combined household income, about $140,000 a year. By most standards, they were doing well. Solid middle class. But here is where their paths split. Sarah's credit score was 620. Her husband's was 780. They applied for the same $350,000 mortgage. Same house, same income, same family. But the bank quoted them 2 very different rates. Sarah's rate, 7.5%. Her husband's, 6.4%. Over 30 years, that difference adds up to over $90,000 in extra interest. $90,000 for the same house, the same family. The only difference was a 3-digit number. And Sarah did not even know why her score was so low. She thought she was doing everything right. The credit system does not reward what most people think it does. It does not measure how responsible you are. It measures how predictable you are as a borrower. And the gap between those two things is where most people lose thousands of dollars. FICO breakdown. The real version. The FICO score used by 90% of top lenders in America is built from 5 categories. Payment history makes up 35%. One late payment can drop your score by 60 to 100 points, and it stays for 7 years. Credit utilization is 30%. How much of your available credit you are using. This is the category most people misunderstand, and we will spend real time here. Length of credit history is 15%. This is directly connected to the step 3 mistake I have been mentioning. Credit mix is 10%. Having different types of credit and new inquiries make up the last 10%. One more thing. When you check your score on Credit Karma, you are seeing a Vantage score, not a FICO score. The score lenders actually use is almost always FICO, pulled from Experian, Equifax, or TransUnion. You have 3 FICO scores. Lenders often use the middle one. Step 3 is coming. The mistake that feels like the right move, but quietly destroys credit scores. Here is the system. 5 steps. The first 2 are foundational. Step 3 is where most people unknowingly damage their own score. And step 5 has recovered thousands of points for Americans across the country. Let us go. Step 1. Build an airtight payment system. Payment history is 35% of your score. The rules are binary. You paid on time or you did not. One late payment, even 30 days, can drop your score by 60 to 100 points. And that mark stays on your report for 7 years. So here's how to make it impossible to miss. Set up autopay on every credit card and loan for the full statement balance. Minimum payment keeps you current, but builds interest. Full statement balance keeps you current and costs you nothing. There's also something most people miss: the statement date versus the due date. Your statement closes on a specific day each month. Whatever balance is showing on that date gets reported to the bureaus. Pay down your balance before the statement closing date. That is the number that matters for utilization, which is step 2. Step 2. Master utilization. The 1 to 9% rule. Credit utilization is 30% of your score, and it is the most misunderstood factor in the entire system. Most people have heard, stay under 30% utilization. That advice is outdated. People with scores above 800 average utilization of around 6%. Not 30, 6. The optimal range is 1 to 9%. 0 is actually worse than 1. No utilization signals you're not actively using credit. The system rewards controlled, low usage, not zero usage. Here's a strategy called AZDEO. All zeros except 1. If you have multiple credit cards, carry a tiny balance on just one card. 0 on all others. Keep that one balance between 1 and 9% of the limit. And remember, FICO looks at utilization per card, not just your total. A single maxed out card damages your score, even if overall utilization is low. Step 3 is next. This is the one. The mistake that feels like progress, but is financially the opposite. Step 3. Never close old credit cards' peak moment. Here it is. You pay off a credit card. You feel good about it. Maybe it was a card you opened in college, and your instinct, the completely logical instinct, is close it. I paid it off. I do not need it. I will close it and move on. That decision just hurt your credit score, possibly by a lot. Here is why. When you close a credit card, 2 things break at the same time. First, your total available credit drops. Say you have 3 cards with a combined limit of $30,000. You are carrying $3,000 in balances. That is 10% utilization. Solid. Now you close one card with a $10,000 limit. Overnight, your total credit drops to $20,000. Your balances stay the same, $3,000. Your utilization just jumped from 10 to 15%, without you spending a single extra dollar. Second, and this is the part almost nobody talks about, closing a card reduces your average age of credit. If that card was 12 years old and your other cards are 4 years old, your average age just dropped from about 7 years to 4 years. That directly impacts 15% of your score. What should you do instead? Keep the card open. Put one small recurring charge on it. Netflix, a streaming service. Set autopay to pay in full. Then put the card in a drawer. The card stays active. Your credit history stays intact. Your utilization stays low. And your score keeps climbing. Step 4. Build credit mix. Credit mix is 10% of your score. FICO wants to see different types of credit, cards, and loans. If you only have credit cards, your mix is thin. A credit builder loan from a local credit union is the simplest fix. You borrow a small amount, $500 to $2,000. The money sits in savings while you make payments. At the end, you get it back. And the payments get reported to all three bureaus. Low risk, real impact. Step 5. Use the dispute system. This is the step most Americans skip entirely. The Federal Trade Commission found that 1 in 5 Americans has an error on their credit report. 1 in 5. That is roughly 40 million people whose scores are being pulled down by information that is factually wrong. Under the Fair Credit Reporting Act, you have the legal right to dispute any inaccurate information for free. Go to annualcreditreport.com. That is the only federally authorized site for free reports from all three bureaus. Pull all three. Read every line. Look for accounts you do not recognize. Late payments that were actually on time. Balances that are wrong. If you find errors, dispute them directly with the bureau online. They are legally required to investigate within 30 days. If the error cannot be verified, it must be removed. People who successfully dispute errors have seen their scores jump 50 to 100 points. This is not a loophole. This is a legal right. And most Americans have never used it. Remember Sarah from Dallas? She set up full balance autopay, brought her utilization down to 7% using the AZDEO method, kept her oldest card open, opened a credit builder loan, and pulled her reports. Found 2 errors on her Equifax file. A late payment she had actually paid on time, and a collection account that belonged to someone else. She disputed both. Both removed within 3 weeks. 14 months later, her score went from 620 to 788. She refinanced the mortgage. Rate dropped by 1.1%. That saves her family $318 every single month. Over 30 years, that is over $100,000. Because she understood a 3-digit number. Your credit score is not a mystery. It is a system. And systems respond to specific inputs. Automate your payments. Bring utilization to 1 to 9%. Never close all cards. Build your credit mix and check your reports because 1 in 5 has errors. Start with one step this week. What is your current credit score? Drop it in the comments. I read every single one. Subscribe to Wealth Storyline. Every week, we break down the financial systems most people were never taught. In the next video, I am breaking down why your savings account is quietly making you poorer. It is already on your screen. See you there. This video is for educational and entertainment purposes only and should not be considered financial advice.